Welcome to the Lazy CEO Podcast, where Jim Schleckser, author of Great CEOs Are Lazy and founder of the CEO Project, features compelling experts and topics for CEOs of mid to large-size companies. Now, let's get started with the show.
Welcome, everybody, to another Lazy CEO podcast. My name is Jim Schleckser. I'm your host, and I am the founder of the CEO Project. So one of my favorite topics is recurring revenue. And I'll get into a definition of that in a little bit. But, you know, when I talk about business model, both in my book, Great CEOs Are Lazy, but also just generally when I talk about it, I talk about recurring revenue all the time. In fact, if I had to pick one thing that defines a great business, it's high degrees of recurring revenue. And many times when I'm in an audience, I have a speaking arrangement, I'll ask, who has over 50% recurring revenue, and, some hands go up of CEOs. And the joke goes that everybody whose hand is in the ground, not up, is not sleeping as well as the people whose hands are in the air. And it's true. Recurring revenue, predictable revenue, lets you sleep better, lets you plan better, and so forth. So I'm going to get into that. So first, let's start with a definition of what is recurring revenue. So recurring revenue is contractually obliged revenue over time. And so this is different than some people talk about recurring or repeat revenue. Repeat revenue is where people come back to you time after time after time. Love repeat revenue, loyalty, gotta have it, love it, amazing. But that's like a grocery store, right? A grocery store has repeat revenue. I happen to go to a particular grocery store. I go there all the time because it's convenient. And they get, over a course of a year, thousands of dollars from me for various products. But I have no contractual obligation. If I decided to go to Trader Joe's or Costco or wherever and buy some of my product, I certainly could. There's no barrier to entry for me to change where I might choose to do my business. Recurring revenue is committed in some way. Either it's you've got to opt out of it. Think about like your cable bill or your telephone bill or your utility bill. Those are phenomenal recurring revenue businesses where you've opted in. In order to get out, it takes work to get out of that arrangement. And usually it's not easy. Like if anybody's ever tried to cancel a cable arrangement, there are processes that you have to go through, and you got to swim the moat and fight the tiger and do everything else to get out of your cable contract. So, and they'll make special offers and so forth, try to retain you, but it's not easy to get out of it. It is effectively you've signed a contract. Think about your cell phone. Particularly if you do one of these deals where you sign a multi-year contract to get the phone for cheaper, getting out of that is painful. And they do this for a reason, right? They're willing to sacrifice some price on the phone in order to keep you as a long-term client and turn it into recurring revenue. So recurring revenue is super important. The other place where you see it are information services like Salesforce and HubSpot and some of these others. They effectively have recurring revenue. They usually have a contract in place. I remember trying to get out of a HubSpot arrangement once, and it was not easy because there was a long-term committed contract. But also, they have your information. And, when you're going in, the answer is, if I want to get my information out, how hard is that? They go, it's easy peasy. Just hit a button. It's all gone. Well, I can tell you from personal experience, it's significantly less easy than hit one button to get your information out. And so there are barriers to exit that relationship, both contractually and frankly, just it's hard. Okay. Compare that again back to the supermarket. It's easy. I can go anywhere I want. There's no cost except for maybe driving a little bit further to move. So we like recurring revenue a lot. Government contractors, for example, one of the reasons why people like those kinds of businesses are long-term recurring revenue, usually a 3, 4, 5-year contract with a committed amount of volume to it. And you can project, you can do what a waterfall of the revenue of that business over time. Even automotive, tier 1, tier 2 suppliers have high degrees of recurring revenue. There's a contract with the automobile provider, And, you can basically count on that revenue for an extended period of time. I'm not going to represent the margin on it, which is a whole nother conversation for another day. It's not particularly exciting, the margin, but the fact that it's predictable is kind of awesome. And the ultimate here are, software as a service. And we're going to get into how you get to that in a little bit, but people love software as a service, or, consulting as a service. Everything's as a service now. And the reason, really what they're trying to do is convert a traditional business model into a recurring revenue model that is predictable over time. So why do we like recurring revenue? Like, what's so great about it, Jim? I mean, why would anybody spend cycles figuring out how to be a higher degree of recurring revenue? Well, there's a couple of reasons. One is the predictability of your revenue is higher. And so budgeting of both revenue, profits, costs are all much easier. And this is particularly true on the cost side, right? I mean, I know more or less what my revenue is going to be in the next year. What I did last year, minus some attrition, plus my growth, there's my revenue number. Now, we could get surprised on the upside and get way more revenue than we expected, but generally there's not a gigantic downside surprise unless you really start screwing up on customer relations and, flexibility and agility and the other things that customers care about. So they're very easy to budget and predict. The second is they're easier to grow. And so, think about, I'm a contractor, meaning like construction contractor. And I finished all my projects and I roll into January 1st. Last year, I did $10 million of revenue. This year, I have zero, like not a nickel of revenue. I've got to go find, just to get back to last year's number, I've got to go find $10 million of revenue, which feels like a lot of work. And I've got to do that every single year. Compare that to a business with high degrees of recurring revenue. We'll call it 90% retention on the prior year revenue, which is a good number. Don't get me wrong, it's a good number. 90% retention. I had 10 million last year. I've got 9 million going into next year, locked down. I know where it's all coming from. I have to go find $1 million of new revenue to get back to last year, and then I get to grow. So that's a far easier business to grow than my first example of a contractor with 10 million, and then there was zero on January 1st. So that idea of recurring revenue has immense impact on the ability to grow the business. Now, let's not discount two elements. Well, let me go back. One of the things you'll observe when you've got somebody like this contractor, they've got to spend a very large percentage of their overhead on sales and marketing. I mean, they're constantly investing in sales and marketing in order to get that $10 million or 50 or whatever their target number is. It's all new every single year. Now, maybe there's a little bit of a tail that rolls over, that finishing out some projects, but fundamentally, there's not much to count on. And so we have to sell our little hearts out in order to get our revenue, which means the sales and marketing spend is going to be higher in that environment on average. What's interesting is, this question of cost of customer acquisition, or CAC, is a number that shows up all the time in recurring revenue businesses. In other words, I'm getting a client, I'm going to hold them for 3, 4, 5, 10 years, whatever the number is, at some value. My cell phone bill might be $100, let's say. So you can do the math. I'm going to have 100 times 12, $1,200 a year, 5 years, $6,000 that client's worth to me. What am I willing to spend to generate a $6,000 annuity effectively, something that pays me over time? And there's a number. So even though the monthly number isn't that high, right? I don't get this big shot all at one time. You're willing to spend a fair amount of money also in recurring revenue businesses to acquire a client if you can retain them. That's the key one. You got to be able to retain them in order for this to pay off, because you're basically creating an annuity that pays off over time. We've got some rules. I've written articles about how much you can spend, but it's a fair amount. Now, the issue is cash flow. In other words, because I only get a little bit of that 6,000 every month, and I might spend 1,000 to acquire that client, I'm constantly pushing money into the business to acquire new clients. So they may be spending a fair amount of money on customer acquisition with the view towards the longer term annuity that gets generated. But that's why a lot of these companies are in cash burn, cash acquisition phase, meaning they're bringing investors in to fund the growth to create the annuity over time. And as long as the machine is working, meaning we acquire them and we retain them, that's a great business model. That's a less exciting investment than, hey, I've got a construction company, give me money for sales and marketing so I can generate revenue just for next year. In other words, that's way less exciting for an investor to put money into. So it's easier to attract investment into recurring revenue businesses than it is to, kind of contractual, not contractual, to project-based businesses, if you will. And then the final one is valuation. The valuation of these businesses is significantly higher. And so to the extent you've got recurring revenue in your business, when and if you ever choose to sell your business, you've got a far more valuable business on your hands. It's probably off of this now, but for in the hey days, just a couple of years ago, software as a services businesses were trading for 8, 9, 10, 12 times revenue. Now, most of us that think about, multiples of profit go, wait a minute, did he just say revenue? Yes, he did. Revenue. And so, I actually had a business that was doing, I don't know, maybe $1 million of revenue. We sold that business for $13 million. And so, it can happen. It can happen to sell for multiples of revenue when it's predictable, recurring revenue, high degrees of recurring revenue. Why? Well, the buyer's basically buying an annuity. Like, as I said, they put the money in, they know it's going to pay out over multiple years. They've done the math on this. These are not stupid people. And, the other reason is, and this is the silly reason, the 26-year-old Harvard MBA is going to be able to put all these numbers in their spreadsheet and model it out, which if you've got a contractor, like my first example, where the work gets done and it's over inside a year, they go, well, what am I going to put in for year 2, 3, 4, 5? And the answer is, we don't know. And of course, everybody's head explodes at that point. And they go, we don't know how to invest in a business like that. Or we won't be willing to give you a lot of money for it because there's a lot of risk against the future revenue streams. In recurring revenue, there's lower risk on the revenue streams, and therefore they're willing to spend more money to acquire those future revenue streams. So you will find that you're going to get more money for your business if you've got a high degree of recurring revenue. In fact, we've dealt with one private equity firm, and their entire investment thesis is monthly recurring revenue, MRR they call it, which is basically to say we want recurring revenue. And they had a bumper sticker that they would hand out that goes, we heart MMR, we love monthly recurring revenue. And if you had it, they'd buy you. Period, all stop. That was their investment thesis. So all those reasons recurring revenue is super important in your business. It can drive a lot of value in your business. It can drive predictability. It can drive hiring. It can drive future sale price, budgeting. All of that's better if you have recurring revenue. The thing to think about, and I did run a business for a while that had what we called a leaky bucket problem. And the leaky bucket problem was this question of retention. So I briefly mentioned it before, and I talked about 90% retention being good. It is critical that you have a decent level of retention, because a recurring revenue model with low degrees of retention looks like a project-based business, project to project, because I brought a client on and they're gone within 12 months. That's a project. The only way to make this an interesting business is to keep them for multiple years. And that means relatively higher degrees of retention. And you can do the 1 over X and come up with the average retention, right? So if I have 90% retention, 1 over 0.9, what's that, 11 years? So on average, I keep people 11 years, which is really excellent if you're 90%. And you can think about some things in your life that you've probably had for 5, 6, 7, 8, 9, 10, 20 years possibly, and you keep paying them every single month. Utility, cell phone bill, cable bill, Verizon, name it, right? You pay them every month. Your termite service, your lawn service, your cleaning service, all of them, high degrees of revenue, or maybe your gym membership, all of them, high degrees of recurring revenue, really desirable business models. So hopefully that's enough to convince you that, if you are starting a new business, you want to have a recurring revenue model. Like, do not start a business unless it's got a very high degree of recurring revenue. Like, all would be a really good start, and then we can kind of work from there. But as much as possible. And I'll give you an example. There's a company by the name of Qualtrics, which does survey software. They got it started in the educational market, and now they've broadened out into all different commercial markets. And they do, subscription-based software sales too. So you can survey primarily customers and employees and other things. So they're gathering data for analytics, which is really important, obviously. But when somebody buys this, particularly a larger enterprise, they buy the software licenses. We love that part. But then there's a deployment component where you have to deploy and install. And that's actually services. That's humans doing work to get the product deployed into an environment. They are so committed to recurring revenue. They basically take all of that revenue, almost all, they do a little bit on their own, and they find partners, Deloitte, Accenture, Walker, name it, Velocity, a bunch of consulting firms, big and small, and they hand all of that work to them. They say, we don't even want to do the services revenue because that would taint our model. We want a relatively pure play recurring revenue software model because we maximize value if we do that. And so to the extent we do services, although they are required for the deployment of our product, we don't want to do them. We'll hand them to you. You can have that revenue, all yours. Happy birthday. And so that's how serious this is. People are literally walking away from revenue that's easier for them to pick up to maintain a relatively pure play recurring revenue. So just take that on board. So let's talk about your business. And you might say, well, gosh, okay, Jim, you got me convinced. Recurring revenue is really important. I buy that. But I don't have much. I have none, maybe. And now I'm all upset that I have none. What do I do about it? And that is a really excellent question. And maybe that's the money, reason to listen to this particular podcast, which is, how do I convert a non-recurring revenue business into a recurring revenue business? That is the question. So let's start with, and the answer is going to depend on the kind of business you have. And none of these are perfect answers. I'll just start with that. But they are ways to think about it, and they are directions you can head in to improve your proportion. Because remember, 20 is better than 10, and 30 is better than 20, and so forth. As a percentage of recurring revenue, these will head you in that direction. So let's say we got a software business, and we've got a traditional pricing model, and we get big purchase price up front, and we get a little bit of a stream on the maintenance on the backside, and that's the model. And what happens is you get addicted as a business to those big, $1 million purchases. I ran a software business, and when somebody would buy a big chunk of software from us with licenses, we would make, $10, $20 million, bam, hugely profitable, went right because of accounting, frankly, but it went right to the bottom line, or largely. And it was an amazing day. And to go to a recurring revenue model is basically a pricing exercise. So in software, it's a little arbitrary how we choose to price for them. I don't know who came up with this idea of big price up front, maintenance on the backside, but anybody who loves recurring revenue is probably going to hit that person with a sock full of pennies. I mean, it's not really a great business model, honestly, for a whole bunch of reasons, by the way, and I'll get into them. But one is, as we convert from that model, when you get addicted to those big purchases, you want to move to, instead of quoting $10 million with a, let's say, $1 million annual maintenance cost, if you can even get it. Many environments, you can't even get a maintenance stream on the software. What you would shift that to is, let's say, $2.5 million a year, every year, forever. And we'll update it, updates, maintenance, all included in the number. So think about year one. Year one, we used to get $10 million. And now we're going to get $2.5 million, $7.5 million swing in our revenue compared to how it used to be to how it is now. And we don't make that up for 4 years, right? 4 years at 2.5 equals 10. Maybe you do it at 3 and it's 3 years, but you get the point. It's a very bad, relatively speaking, first year to first year comparison. Second year is better, third year is better, fourth year is better, so forth. And we eventually get there as long as we retain the client. But it is painful to go from, swishing them revenue over to its side and taking it over time. I'm going to say that in a public environment, this may be impossible to do. Because think about the explanation you're going to have to make to your shareholders about why your revenue's off. And don't worry, it's just as good as it used to be. In fact, it's going to be better. That's a hard conversation to have. So I would argue every new product that gets launched looks like this, and you sort of move over time in this direction rather than doing it as a hard shift, do it over time and slowly move yourself to this model over a few years versus doing it hard stop, move over, and we're done. But what you'll build is a very different model. Now, the cost base is going to look differently. But remember, one of the big savings here is the sales and marketing cost. I don't have to spend as much money on sales and marketing, particularly if I've got a relatively installed base. I'm renewing it, I'm upgrading them, I'm adding feature sets, I'm adding to their recurring revenue spend with me. And so I don't need to have like, okay, we've got to go find more clients. If we're going to make $50 million of revenue, we got to go find $47 million of new clients every year. And we've got a giant Salesforce to get that to happen. You don't need as many people. You may not need as many people on the technical side as well. So these are smaller businesses, frankly, more profitable and more valuable when you make that shift. So that's the move. Smush your pricing over, change the way it's simply a pricing exercise. The issue is the pain of transition from one to the other. And you probably need to have a little bit of a war chest built up, in other words, cash in the bank, in order to make that transition from one model to the other. But the long-term play is better, more predictable, and more valuable business. Like I said, if I had a $20 million software business that was, traditionally priced, in other words, big chunks of software, and that's how we made my money, or I had a $5 million recurring revenue, and that business might be worth, let's say it's $10 million and it makes $1 million. I'll make that up. Makes $1 million a year. That business is worth, I don't know, 10, 12, $15 million, depends on the buyer and how much they like it. Shift that to a $5 million recurring revenue model, right? So we just smush the revenue over to the side, maybe grow it a little bit. That business, even in the bad times, is probably worth 4 times revenue or 5 times revenue. It's worth $20 to $25 million. So the arbitrage here is I went from a $12 million valued business to a $20 to $25 million valued business with the same number of clients and the same amount of software being used, right? So that's the power of making that transition if you want to. It's an immense value creator for you and your shareholders. I had one other point in that area and I forgot it. But anyway, that's the basic point on software as a service and the move from a traditional model to the new model that you might want to make. I will tell you, I've tried to make this. You can't go soft to the hoop on this one. You have to go hard to the hoop. And what I mean is, it is not negotiable. That's the new model. If you want to use the software, this is the way it looks. If you don't want to use the software, we're okay with losing the client, because particularly clients that have a lot of cash will do the little net present value analysis and say, well, I did the math and it's cheaper for me to just buy it up front, which is probably true, honestly. But if you are willing to go back to the old way, you'll never go to the new way, particularly have clients with money. The other value, and then I remember my point, is think about the value creation for a client. If you think about the value creation of a client of any product, but software in this case, the value is created sort of uniformly over time. Let's say every year it's about the same, or maybe it grows slightly over time, the value that they get from using your software, design software, quoting software, accounting software, whatever it is. But yet the historical pricing model was give us a big chunk of cash and then a little chunk of cash later. And that is not matched to the value creation curve. So recurring revenue, and this is the pitch for the client, the value creation to the client looks now like the pricing model of the software. In other words, you create value at the rate that you pay us for the software, and so they're matched. And to the extent we create more value than we cost, this is a good deal for you because you're going to pay us 1 and you're going to create 3 of value every month going forward. And so it's an arbitrage for them in a positive way, as opposed to the big chunk of capital up front. So that's software. Services have a similar kind of move. You're traditionally pricing big projects. You want to move to more of a retained model. What I've seen people do is productize their services here into monitoring type services. So if you think about as consultants, we offer a diagnostic capability and we offer a therapeutic capability. So find the problem, fix the problem. The monitoring component of your business, like figuring out where the problem is, looking at metrics and so forth, that can be turned into a recurring revenue model. So the classic example here is Gallup. and their Q20. So they do an employee engagement survey, a 20-question employee engagement survey. That's a diagnostic, like where is the heartburn in your organization in terms of employee engagement. You really want to do it every year-ish to make sure that things are going in the right direction. And then the diagnostic, the therapeutic, which is now that we know where the problem is, let's help you fix it. They don't do a ton of that work. They do some, but a lot of that goes to other people. They also license this diagnostic tool to other people. So move one as a services company is think about your diagnostic competency and move that to a recurring revenue model that somebody needs to do every year. And so that's certainly one move. The other move is to have a maintained service level of support over time. Now, generally, if we do interventional work, that's not going to work, but we're sort of as a staff aug or a support work, that tends to be a place to go. The last one is if you make a product. And products are harder, but we have a roadmap here, which is if you think about all the things that go around a product, that's where your opportunity for recurring revenue sits. So don't think about recurring revenue of the product itself, although people have tried to do that. Look at your Keurig, right? They sell you a Keurig coffee machine and then they sell you pods in it, razors and razor blades. Everybody's tried to move to we'll sell you the device and we'll sell you the stuff to go in the device, and that's how we make our money. That's certainly an option if you have a consumable element to your product. The consumable becomes your recurring revenue element of the product. The product is almost irrelevant. The consumable becomes the business. And so all we're trying to do is get machines in place that consume your consumable as fast as we possibly can, because we're going to make all our money on the consumable. And once they're locked into your design, it's very hard to go somewhere else. And so that's what Keurig did. That's what others do, Nespresso, so forth. So consumables are certainly one option, particularly if the consumable is a significant value piece of the equation. So coffee, the coffee is the big value proposition. The machine just makes the coffee. And so the machine is not critical as long as it works. It's more about the consumable. So that's one option. The second is training. And ongoing training is important, particularly if it's a sophisticated system and there's turnover in your client base. There's not only training required when they first do it, but there's training over time as people get replaced. We dealt with one business that was sitting alongside SAP, and they did training, and they were very, very good at it. And they were like a $300 million business just doing training on SAP. As people would deploy SAP, as people would turn over, they would need more training. And so they had the recurring revenue element of the SAP business model on the training side. So training is another one. And if you're giving away the training on your product, stop. You should be charging for that. Like that really has a value, and you need to represent the value on it. The next one is maintenance. And particularly here, we're selling, people love spare parts sales and maintenance support and so forth. But I'm going to say there's an opportunity to, and a lot of times we do that for free, by the way, because, well, it's super customer service, it's lifetime support, love all that. If that's part of your brand, keep it. But if you're giving it away, this has real value to clients. The support of the product, once it's in the field, has real value, and you really need to think about it. My recommendation here is to shift this to an insurance-like model. So in other words, get away from charging by the part, go to, for $100 a month or $300 a month or $1,500 a month, we'll maintain the product. If it breaks, we fix it. We provide the spare parts, all in. Now, you have to do the math. The underwriting of this particular move is really important. In other words, the reliability of your product and the consumption of maintenance parts and so forth, you need to really, really understand that so that you don't get stung on selling effectively insurance to your customers on the product. But if you know your math, meaning I know how reliable the product is, this can be a huge profit generator. It does, interestingly enough, change your engineer's view on product design. If the maintenance of the product is the problem of your customer, they may take one design view on the product. If the maintenance of the product is now our problem and our cost, they may take a different view on the design of product. So it may take a little while for this to fully unwind and turn into a real business, but you might invest more in your machinery, for example, to create a more reliable product. So your insurance product, your maintenance product is much more valuable. The example here is Best Buy. So anybody who's been to Best Buy in the last decade, 2 decades, when you go to the cash register with your giant big screen TV, The question they ask is, would you like a maintenance contract on that TV? And, some people buy them, some people don't. I happen not to buy them for a bunch of reasons. I usually joke, I say, gee, is it likely to break? They go, oh, no. I go, well, then why would I need maintenance? Which is not productive. But anyway, the point is, a few years ago, Best Buy, they don't make really very much money on selling product. They made 80% of their profit on maintenance. So it's a hugely profitable item. If you have a high value, but high reliability product, like a big screen TV, people want to insure it just in case, and you can make gobs of money. So that's a great, and you can renew that and renew that and renew that. And so maintenance in the form of insurance is another place where you can really make money around your product. And then the final one I'll just talk about, there are others, but these are the big ones. The final one is financing. And, sometimes back to this idea of shifting a large purchase into a monthly cost, financing allows a customer to do that. So they basically synthesized a recurring revenue purchase of maybe a potentially large capital acquisition. We see this in machine tools all the time. Almost nobody writes a big check for a $5 or $10 million, multi-spindle CNC machine tool. What they do is they finance it and they pay for it over 2, 3, 5 years, whatever the number is. So they've just taken that big price in the beginning, they folded it over on its side, and they pay over time, which again matches their value proposition. But you, as an equipment manufacturer, would say, why wouldn't I want to offer that financing for my clients? And why? Because there's a spread available here. In other words, let's say I lease it to them and I charge them 9% interest built into my lease. It's a little invisible. For anybody who's leased a car, who's tried to figure out what the interest rate is, it's almost impossible. That's intentional. Same thing's true. It's very hard to pull the interest rate out in a lease of equipment or a product that you might make. And so you've got an opportunity to, let's say, charge 9. If your cost of capital is 6, you're gonna put up more debt on, or have somebody who finances that for 6. You're getting 9. You get a 3% spread, recurring revenue every month, and you don't have to do anything for it. Somebody else will collect the money. There are firms that will do this. So you don't even have to lay the cash out here. You're going to get paid for your machine. It's now the problem of the financing company, but you make a spread going forward. So financing can be a really powerful way to go, depending on our clients. We've done this with a number of CEO project members super successfully. And the other element is, it grows your sales because people say, hey, I don't have to come up with a big check. I can just finance it and off I go. Copiers have been like this forever, for example. So that's recurring revenue. Hopefully in this conversation, you become convinced it's super important, which it is. It's a better business model, which it is. It's more valuable when I sell my business, and that's for sure. And there are ways, no matter where you are, even if you're at 0, there are ways to move from your current position to a place where you have more recurring revenue in your business model. So if you want to talk more about that, please contact us at the CEO Project. We love, love, love recurring revenue. I should probably get bumper stickers made. And it's one of our favorite things to talk about. We'd love to chat with you if you want to have a conversation on how do you grow your recurring revenue. In the meanwhile, do well. We'll see you next time on the Lazy CEO Podcast. Thank you. This podcast is brought to you by the CEO Project. At the CEO Project, we work with CEOs to help them grow their business. And our members represent billions of dollars of revenue and profit. And frankly, amongst all of us, we've probably made every mistake in the book, including some you haven't made yet. So if you want to learn from the experience of a bunch of really seasoned CEOs, we're a great place to hang out. In this podcast, what you're going to hear are some of those ideas, concepts, and things that are just going to help you on your journey. If you want to find out more, reach out to us at theceoproject.com, or you can contact me personally at jim@theceoproject.com. Happy listening.
Thanks for listening to the Lazy CEO Podcast. We'll see you next time, and be sure to click subscribe to get future episodes, and check out our website, www.theceoproject.com.